You know that feeling when you're opening a new bank account and suddenly you're turning your house upside down looking for a utility bill?
Oh yeah, digging through drawers for that one specific letter.
Exactly. A crumpled piece of paper, probably with a coffee stain on it, that somehow serves as the ultimate proof that you exist and live where you say you live.
Right. It's incredibly clunky.
It is. It's frustrating. And looking at the financial system we operate in today in 2026, securing money moving at the speed of light with these analog anchors is, well, it's completely breaking down.
It really is.
But before we get into today's discussion on the radical evolution of Know Your Customer regulations, or KYC, a quick administrative note for you. By taking the quiz at the end of this audio session, you will earn your Continuing Professional Development, or CPD, certificate.
Which is a great bonus.
Definitely. So our mission today is to unpack the three massive shifts that are turning KYC from this frustrating regulatory roadblock into a really powerful competitive advantage. And to help synthesize all this, I've got our resident expert here.
Thanks. Yet the pressure to modernize this entire framework, it isn't just coming from frustrated customers who are tired of the paperwork.
Right, it's bigger than that.
Much bigger. We are looking at a massive macroeconomic squeeze. The Financial Action Task Force, or FATF, pushes incredibly stringent global standards for anti-money laundering. And, when a jurisdiction gets gray listed, the macroeconomic consequences are just severe.
Because foreign institutions are forced to apply enhanced due diligence to every single cross-border transaction.
Exactly, which dramatically increases the cost of capital. An international trade payment that should take minutes suddenly takes days.
Wow.
Yeah, because it gets caught in this massive web of manual compliance checks at correspondent banks overseas.
Yeah.
And that international pressure collides directly with the realities of, say, the South African Reserve Bank and the FSCA trying to manage a dual economy.
Okay, let's unpack this, because the dual economy aspect is fascinating.
It's the core of the challenge. We have a highly sophisticated, digitized, formal banking sector sitting right alongside this massive cash-based informal economy.
Right.
If regulators strictly enforce traditional, rigid verification rules, they risk locking millions of individuals and micro-enterprises out of the financial system entirely.
Which defeats the whole purpose of financial inclusion.
Exactly. The infrastructure of market trust itself has to evolve to accommodate both of those realities.
So to understand where we're going, we kind of have to look at what's breaking down. For decades, the industry relied on these point-in-time checks.
Yeah, the classic paper trail.
Right. A customer hands in a physical ID book and a proof of address during onboarding. A compliance officer verifies the documents, ticks a box, and just files them away.
And then the customer's risk profile is basically treated as static until a mandatory regulatory review a year or two later.
Which fundamentally assumes that risk is just frozen in time.
Which is a terrible assumption. A user's financial behavior, their transaction velocity, their jurisdictional exposure, all of that can completely change overnight.
So what's the first big shift happening here?
Well, the first shift is moving from static verification to dynamic digital identity ecosystems. So instead of that document-heavy episodic approach, the industry is shifting toward dynamic, reusable digital identities.
Meaning less paper, more real-time data.
Exactly. We're seeing electronic KYC, or eKYC, automating verification directly against trusted national databases. And this is increasingly paired with behavioral biometrics on the user's device and secure digital identity wallets.
Okay, to visualize this architectural shift, I like to think of it this way. The old system is like showing your passport at every single door inside a high-security building.
Yeah, that's a good way to put it.
You want to open a checking account. Passport. Apply for a mortgage. Passport. But the new ecosystem operates like a biometric VIP FastPass. The network recognizes your verified credential once, and then all the subsequent doors just open seamlessly.
That's spot on. And global payment networks like MasterCard and Visa are actively laying the pipes for these interoperable frameworks right now.
So how does that actually work under the hood?
They use tokenization. It ensures the identity data can move securely between different financial institutions without ever exposing the raw underlying information.
Oh, that's clever.
Right. But the application here in South Africa is particularly fascinating because of our high mobile penetration. A smartphone essentially becomes the proxy for traditional documentation.
I imagine that changes the mechanics of financial inclusion entirely.
Oh, fundamentally.
Because think about it, if a small business owner operating in a township doesn't have a formal commercial lease agreement to produce that required proof of address.
They can still be onboarded using alternative data streams.
Right. The system can just analyze their mobile usage history, maybe airtime purchase patterns, or geolocation consistency to establish a reliable risk profile.
Exactly. The alternative data fills the precise gap left by the lack of formal, traditional documentation. By analyzing the metadata of how a device connects to the network over time, institutions can verify a user's digital footprint with a really high degree of confidence.
But there's a catch. Right.
Always. Transitioning a national economy to a purely digital ecosystem introduces significant infrastructural hurdles. We still face a stark digital divide when it comes to hardware access and broadband reliability.
Yeah, I mean, if the only gateway into the formal economy is through a high-end smartphone and an uninterrupted LTE connection, we inadvertently exclude the exact demographics this technology is supposed to help.
It's a massive risk. And not to mention the security architecture required for all this.
Oh, for sure. Centralizing biometric data like facial recognition maps or thumbprints, that just turns that central database into a massive honeypot for sophisticated cyber attacks.
Precisely. The governance frameworks and encryption protocols have to be absolutely flawless to prevent catastrophic breaches.
And even if you get the security right, replacing paper with these centralized biometrics creates an entirely new operational bottleneck, doesn't it?
It does. Think about the volume. If millions of users are instantly authenticating and transacting every second using these digital fast passes, human compliance officers cannot possibly monitor those immense transaction flows manually.
Which brings us to the second massive shift. Because if customers are moving through the system at the speed of light, the old security checkpoints are going to be completely overwhelmed.
They'll collapse. Fast onboarding means the old checkpoints just buckle under the sheer volume of data. So the second shift is moving from rule-based compliance to intelligent risk detection.
Because traditional role-based systems are already failing us, right?
Oh, spectacularly.
Yeah.
Historically, anti-money laundering platforms relied on hard-coded static rules. Like, an institution might set a tripwire to flag any transaction exceeding a specific RAND value or block interactions from high-risk jurisdictions.
That sounds reasonable in theory, though.
In theory, yes. But the operational cost of those static rules is staggering. In legacy systems, false positive rates routinely hit 90 or even 95%.
Wait, really? 95%?
Yes.
So human compliance teams are spending 95% of their working hours just chasing down ghosts.
Literally chasing ghosts. A legitimate small business owner makes a slightly larger than usual payment to a new supplier, and it triggers the exact same alarm as a money launderer.
And then the entire system grinds to a halt while someone manually investigates the alert.
Exactly. And those tripwires are inherently reactive. They only catch known historical patterns of illicit behavior. They offer virtually no defense against adaptive, sophisticated financial crime that's constantly mutating.
Right, because criminal syndicates know exactly where those static thresholds are set.
They know the rules of the game better than anyone.
So let's examine the mechanics of how modern financial crime operates to understand why those rules fail. Criminal organizations use what's called synthetic identities, right?
Yes. Synthetic identities are a huge problem. They don't just steal a single person's wallet anymore.
They combine a real stolen identity number with a fabricated name, a fake physical address, and a manufactured digital footprint.
And then they play the long game. They will slowly build up a fake credit history over months or even years. It's a process known as nurturing the identity.
Wow. Nurturing a fake person.
Yeah. They'll apply for small store credit cards, make regular payments, establish this veneer of legitimacy. So by the time they apply for a massive commercial loan or attempt to move illicit funds, they look like a premium, low-risk customer on paper.
And a static rule misses that completely because the underlying ID number checks out as technically valid.
Exactly. The tripwire never gets tripped during the onboarding phase.
The static rule sees a valid ID number and just authorizes the account creation.
Right. And this is where artificial intelligence and machine learning completely change the paradigm. Tech providers are deploying these AI-driven compliance engines capable of processing colossal volumes of structured and unstructured data in real time.
So we're moving the industry toward continuous behavioral monitoring.
Exactly. Instead of analyzing an isolated transaction in a vacuum, the AI maps out complex graph networks. It analyzes how different Nodes like specific bank accounts, IP addresses, mobile devices, how they all interact with each other across the entire financial system.
So the AI calculates the velocity and routing of the activity.
Yes. It spots the anomaly by recognizing that, say, a supposedly new retail user is suddenly exhibiting the highly complex, layered financial routing patterns typical of an established money laundering syndicate.
And then the system dynamically updates the user's risk score and flags the anomaly instantly, probably before the funds even leave the institution.
That's the goal. But I have to highlight the immense technical challenge of implementing that continuous monitoring.
Wait, let me push back on this utopian tech vision for a second.
Hmm.
If an AI is constantly monitoring my financial behavior to update my risk score dynamically based on billions of data points, aren't we risking serious algorithmic bias?
That is a very valid concern.
I mean, what happens when a complex, opaque algorithm unfairly locks an innocent person out of the financial system? The black box said so is not a legally defensible answer to the Reserve Bank.
This raises an important question, and you've hit on arguably the most significant technical hurdle in continuous monitoring: regulatory explainability. An institution must be able to demonstrate exactly why an automated decision was made.
So if the AI model operates as a black box, it just fails the fundamental requirement of auditability.
Exactly. Regulators require clear documentation of the future importance, meaning which specific data points caused the AI to trigger the freeze. Did the algorithm flag the account because of the velocity of the transactions, or because the IP address resolved to a high-risk jurisdiction?
And if the bank can't answer that question because the algorithm is totally opaque?
They face massive regulatory fines, so it requires incredibly stringent model validation.
So we still need humans in the loop.
Absolutely. The technology is incredibly effective at highlighting subtle network anomalies that human eyes would inevitably miss. But institutions still need human compliance officers who can parse that flagged data, understand the algorithm's underlying logic, and basically maintain ultimate accountability for the final decision.
Which makes sense. And successfully balancing that tension between lightning-fast digital onboarding and transparent, auditable AI monitoring, that unlocks the third and maybe most important evolution here.
It really does. It shifts the entire function from a reactive cost center to a proactive growth engine.
Yes. Shift number 3, from regulatory burden to strategic differentiator. Because we are looking at a move toward perpetual KYC.
Right, perpetual KYC. Instead of annoying the customer every 2 years for updated utility bills, the system continuously verifies their data in the background against trusted registries.
It completely reframes identity verification. It's no longer a despised regulatory burden. Customer expectations in 2026 are entirely shaped by seamless digital experiences.
Oh, completely. If I can order a cab or groceries with one tap, why should opening a bank account take a week?
Exactly. An institution that forces a new user through a clunky, friction-filled onboarding process isn't just frustrating their compliance department. They are actively losing market share to agile competitors who actually get the user experience right.
And it's not just banks anymore. We are seeing KYC treated as critical infrastructure across multiple sectors, extending far beyond the traditional banking sphere.
Like telecoms.
Yes, consider the telecommunications sector. SIM registration in South Africa requires rigorous identity verification to prevent network abuse and mobile money fraud.
Or the insurance sector. Rapid identity verification directly accelerates the underwriting process and speeds up claims validation.
Exactly. If a platform embeds seamless checks into the digital journey, they drastically lower application drop-off rates. They capture revenue faster simply because the user doesn't abandon the process halfway through out of frustration.
And the quality of the verified data gathered during a frictionless onboarding process also allows institutions to proactively offer personalized financial products.
It shifts the entire dynamic of the customer relationship from one of suspicion to one of service.
Here's where it gets really interesting. It's the difference between a grumpy bouncer and a highly observant maitre d'.
I love that analogy.
Right. The old verification model acted like a bouncer at the door, scrutinizing your documents, making you wait in the cold, treating you as a potential threat.
Barking orders at you.
Yeah, but the new model operates like a maitre d'. It recognizes you instantly, anticipates your needs based on a secure verified profile, and customizes your experience the second you engage with the platform.
But to achieve that level of proactive customer experience, organizations really must dismantle their internal operational silos.
Meaning different departments actually have to talk to each other.
Shocker, I know. Compliance, IT, risk management, and customer experience teams cannot operate in isolation anymore. They have to share the same underlying data architecture and work from a single, unified view of the customer.
So, what happens when you combine all three of these shifts in the real world? Let's look at the macroeconomic results of that integration.
Well, if we combine these digital fast passes with AI graph network monitoring, the immediate byproduct is a massive spike in market liquidity.
Because capital isn't trapped in a 2-week administrative onboarding queue.
Exactly. It flows instantly to where it can be deployed.
The velocity of money increases significantly when trust is established in milliseconds rather than days.
And furthermore, treating verification as a streamlined utility rather than a proprietary hurdle levels the competitive playing field.
Oh, that's huge for startups. Agile fintechs don't need to build a bloated 50-person compliance department to onboard users safely. They can just plug into these digital identity ecosystems via APIs and compete head-to-head with legacy banks.
Which brings us to the horizon line, looking beyond 2026. Because the trajectory points toward compliance processes that are entirely invisible to the end user. And the truly disruptive mechanism here is the shift toward decentralized, self-sovereign identity models.
Wait, self-sovereign identity, let's break that down. In a traditional centralized model, the bank holds your sensitive identity data, your ID number, your biometric scans, your financial history on their proprietary servers, which creates that dangerous honeypot we mentioned earlier.
Right, but self-sovereign identity flips the architecture completely. You, the individual, own and control your personal verified credentials securely on your own device.
So how does the decentralization mechanically work?
It operates like a cryptographically sealed envelope. Instead of handing the bank your raw data, you hand them mathematical proof that the contents of the envelope have been verified by a trusted issuer without ever opening the envelope itself.
Oh, wow. So the underlying mechanism relies on zero-knowledge proofs.
Yes, exactly.
So a financial institution system might ask the network, is this person over 18 and a legal resident of South Africa? And your self-sovereign wallet uses cryptography to answer yes, providing absolute mathematical certainty to the bank without ever revealing your actual birthday or your home address to their servers.
Precisely. You decide exactly who gets to verify what specific piece of information, and you hold the power to revoke that access at any time.
That fundamentally solves the data privacy honeypot problem.
Completely. Because there is no massive central database for hackers to breach anymore. The data remains distributed across millions of individual encrypted wallets.
It also enables seamless cross-border interoperability. I mean, a self-sovereign credential verified by a trusted node in South Africa could be instantly recognized and trusted by a smart contract or a bank in Europe or Asia, completely eliminating the need to repeat the underlying background checks.
It's revolutionary. So if you are building a business or leading a team right now, the implication is incredibly clear. You have to stop treating identity verification as a siloed, box-ticking exercise.
It's a cross-functional capability.
It underpins everything, from user acquisition to global expansion. Competitors who utilize these cryptographic frameworks and AI monitoring tools are going to build inherently safer, faster, and more inclusive experiences.
The organizations that thrive will be the ones that align their people, their processes, and their tech architecture so that identity verification becomes the invisible foundation of their competitive advantage.
Let's quickly recap the mechanisms we've unpacked today.
Sure.
We explored the collapse of the point-in-time paper trail, transitioning to dynamic digital identity ecosystems that use alternative data to bridge the gap between formal and informal economies.
Then we examined how continuous AI behavioral monitoring maps graph networks to catch sophisticated synthetic identities, the ones that easily slip past static rule-based checkpoints.
And finally, we looked at how integrating these technologies transforms identity verification from a regulatory roadblock into a really powerful engine for market liquidity and strategic differentiation.
The transition from a reactive manual constraint to a proactive automated utility really represents a fundamental maturation of the global financial system.
It really does.
But before we wrap up, I want to leave you with a thought to mull over regarding the mechanics of self-sovereign identity we just touched on. If decentralized identity truly takes off, and individuals eventually hold the cryptographic proof of their own verified credentials without relying on a central authority to vouch for them, will traditional financial institutions eventually lose their historical power as the ultimate gatekeepers of economic trust?
Now, that is a paradigm-shifting question for the future architecture of the industry.
Definitely something to think about as you navigate this rapidly changing landscape. Thank you for joining us for this analysis. We really appreciate your time and your curiosity.
Thanks for listening.
And as a final reminder, don't forget to take the quiz linked right after this session to claim your CPD certificate. Until next time, stay curious.